From Barangaroo Studios, the ausbiz COB is the key stuff you need to know about the day in business and finance.
Welcome to the COB. I'm Juliette Sarli. On a very busy day on earnings season, we've had a number of fabulous CEO interviews. Of course, you can catch them all up on ausbiz.com.au. We're also closely following Medicus, which has posted a profit of $82.8 million for the full financial year. That's up 35.3% from in 2023. Medicus will pay out a dividend of 22 cents per share to shareholders. Revenue from ordinary activities rose more than 29% to $161.5 million. Medicus forecasting a strong full year 25 and sees more opportunities due to improved prospects in North America for Visage 7, its imaging platform. Let's get the numbers and more details now with Medicus MD and CEO Dr. Sam Hupert. Thanks so much for joining us. In your words, Sam, what do you think were the highlights from the year?
Well, I think we had a very strong year. As you mentioned, our financials all headed in the right direction. Revenue, profit, our retained earnings went up significantly, but we also had a record year of sales, which augurs well for FY25 as these systems are implemented. And we also had a record year for implementation. So we made sure we kept on top of, our implementation timeline so that we don't have backlogs coming into this year. So pretty much everything moved in the right direction. So we were very pleased with it.
Underlying profit up by more than 35%. Is that kind of growth sustainable?
Every year the base gets bigger, so the number gets bigger, but we do believe there are a few extenuating circumstances. As I've mentioned, we have already locked in some of that growth with the contracts we won in FY24. Our base gets bigger every year. We haven't lost a client. We've had 100% retention. So whilst it's always, a steep hill to climb because it is a big number, it's definitely doable with our business model and the fact that we've already pre-sold most probably the most we've ever had coming into a new financial year.
Well, talking of sales, North America accounts for a lot of your underlying business, I guess. Sam, what sort of sales opportunities are you pursuing further?
So North America is the world's biggest market. I think most people know that, but it's also the most dynamic, particularly when it comes to healthcare IT spend. It's not government-based. A lot of the large organisations are not for profit, so there's not that bureaucratic impedance, as I call it. We have about 7% of that market, which is material, but that means there's a lot of runway ahead of us. So I think we do need to and are planning to win more work, and having a referenceable base makes it a lot easier. Never makes it easy, but so we think there's a lot of market ahead of us that will help us fill that gap in terms of new sales.
And is some of that opportunity potentially in the likes of Europe and Asia?
We're basically saying mostly in America. That's where the main activity is, but there's nothing to stop us if there are opportunistic opportunities where someone is definitely looking at a system. There's nothing to stop us from implementing there, and we do have a base in Europe. We have our R&D office in Germany, and we have some large government clients in Germany, so we can build on that.
When we look as well in terms of your cash and other financial assets, nearly 30% higher than last year. What's your plans to sort of deploy some of this?
Well, our first and foremost is to invest in the business in terms of making sure of our R&D capability, keeping ahead of competition, which I believe we've been able to do. I think it's also important we have enough numbers on the ground to service our growing user base, both from a technical and clinical point of view. So that's the number one use of the money. Then we return dividends, roughly 50% of profits, fully franked. But we still have enough dry powder so that if there are any investment M&A type opportunities that we feel we could add value, we certainly will look to do that.
When you talk about dividends, you have seen a 33% increase, I believe, in terms of total dividends for the year. Again, is that sort of payout or growth sustainable?
We believe so, and it follows obviously the profit growth. So our guideline's roughly 50% of profit after tax, and we've been able to maintain that for many years now, including this year. So we don't see any reason why that can't continue.
Let's talk about some of your technology, I guess, as well. So Visage 7 you're seeing being adopted beyond radiology. What are the hopes for that?
Well, radiology is the big lift when it comes to imaging. It's about 70+% of the imaging load in a healthcare enterprise. But then there are many others like cardiology, which is the first cousin, as one would think, of radiology. And now a lot more images, both in terms of photos and videos, are becoming an integral part of the record. So our view is to try and expand the product into those what we call other ologies and be the one imaging platform for a healthcare enterprise. Now, it's never been done before. Cardiology will be our first step. It's the biggest one. And then after that, we will look at the other ologies in turn. So it's an adjacency. Our first thing is really to get the radiology piece or diagnostic imaging piece in first. It's the big lift, but we do see opportunity in the future of these other ologies coming on stream as well.
How much are you looking towards AI as well and adopting that?
Well, that's the multi-billion-dollar question. I think AI is talked about in every industry, but healthcare was one of the first adopters of AI. It's gone through its excitement phase, it's gone through a disappointment phase, and I think we're starting to see some traction for AI commercially within healthcare and particularly in imaging. 80% of the FDA cleared algorithms in healthcare are imaging related. So we see that we're at near that point of where it starts to become mainstream and commercial, but we're not quite there yet. But when it does come, clearly it will come through multiple avenues, and we're positioning ourselves to be a participant in the avenues that we can see.
Let's talk as well in terms of what you've got in your pipeline. You mentioned that it has been a good year in terms of contracts and sales. What else is in the pipeline, I guess, for full year 25?
Well, we've noticed since COVID in particular, and maybe even more so in the last 18 months, a lot more organisations putting out RFPs. So there was nothing that really forces them to come to market other than their own technology is getting long in the tooth or not suiting their needs. And we've seen an increased cadence of that. I think two factors are the main ones. One is the data sets are just getting so much bigger that legacy technology just cracks under the load. It's not uncommon for certain tests to be multiple gigabytes each, and if you had one of those tests before, you need to look at two of them together. So it's not uncommon to open 8, 10, 12 gigabytes of data in one examination and its comparison. So big data sets, and the other really big movement and paradigm shift has been towards cloud. And I think security is one of the key drivers behind that, simply because on-premise has been shown to be nowhere near as secure as a good cloud implementation.
So how much are you addressing the concerns about security and safety and spending into that aspect as well?
Well, we haven't done an on-premise implementation in the US in 4 years, and I think we're the only ones. We are fully cloud engineered, so all of our clients can just offset all that technical debt in terms of on-premise data centers and staff, and it's purely just a connection to the cloud, and then we manage everything else. So I think that's a very major step towards a far more secure environment than the typical on-premise that had been the case historically.
Now, Sam, somebody that had held your stock from the listing would be doing very well, even if they've just held it for the past year or 5 years. I know you can't control the market, but you must be encouraged when you see these kinds of returns. again, with your thoughts on that, I know you can't control the market. Do you think you're sort of sitting at fair value?
Well, again, I leave the value to the sort of the market and the analysts and the experts that cover it. I think there are a few things. It really depends on which prism you look at us through. If you look at us through the the standard PE, then you'll get one equation. But having said that, there are many companies that are growth companies that have no E. It's just pure revenue figure. So I think we're a little unusual. We're a hybrid. So on the front end, we're growing at 30% plus a year. That's not just revenue, but also profit. On the back end, we're very conservative. We don't have any debt. We accrue cash and we pay dividends. So that hybrid nature makes us maybe a little difficult to value. But I think, as I said, it works well for us as a business. And then there's the US investors that tend to look more. You've got 7+% of the market. What's to stop you from getting to 15% and beyond that? So that they look at it more from a future market shares perspective. And each of those, each prism gives you, I suppose, a slightly different answer.
Well, a lot of analysts that we speak to, including James Garish from Shaw and Partners, I think, are saying it's hard to do anything but rate a buy on PME. The market certainly at this point seems to agree. And I guess to that other point, whether or not it's expensive is a question, as you say, is for the market. But I wanted to ask you as well, Sam, yes. And this was one that came from one of our viewers that asked me to ask you this. How are you enjoying the role? And if you had to leave, who do you think could replace you?
Oh, well, I've been in the role for 40-something years. I did step back as CEO in 2007 because I felt maybe I'd been CEO since the formation of the company, and maybe someone would be better capable of handling particularly overseas expansion. I did come back in 2010, and I was ostensibly for about 2 or 3 years, but clearly I'm not good at counting because I'm still here. I think a lot of the role that excites me, and I'm sure excites a lot of our staff, is not purely the financial side, which clearly is important, but we are a clinical product. I am a clinician. That's my background. And I think being able to move the needle in what radiologists can do and how they do it, particularly around some of the research projects, in and around AI, but not exclusively AI, I think are very rewarding. So at the moment, I think, seeing that develop has been incredibly gratifying, not just to me, but I think to all of our staff.
All right, Sam, we thank you very much for your time this afternoon. Pro Medicus MD and CEO Dr. Sam Hupert, as I mentioned, shares doing very well on the back of these results and, of course, in the overall market. But, it was a good day on the market too. We're very much in the thick of it when it comes to earnings. So talking there about Pro Medicus, but don't forget we had CBA today. Now profit was 2% lower than last year, but beat market expectations. Koshti had a great chat with Matt Common, the CEO. You can find that on ausbiz.com.au shortly. We will put it up momentarily, but we also had the likes of AGL. It, of course, tripled its profit due to the higher electricity prices as well. So many companies reporting today, and we will get to a couple of those in our corporate stories. But the other thing was that the RBNZ shocked a little by cutting rates. There was certainly a lot of expectation that this would be one of the most interesting meetings for some time for the RBNZ. But I spoke to ANZ's Kiwi economist about 10 minutes before the decision, and she was certainly in the camp that they didn't think the RBNZ would cut this month. They did, and it certainly sent the Kiwi plunging against the dollar. So the cash rate in New Zealand now at 5.25%. And some news as well with ASIC, the corporate regulator, suing the ASX. And of course, this is over its CHESS replacement project. So ASIC alleging that statements made in ASX announcements in February 2022 that the project remained, quote, on track for go live in April 2023 and were progressing well were misleading. ASIC yet to determine the penalty it will seek for the ASX alleged contraventions, but you did see shares in the stock exchange provider under pressure today. Let's have a look at some of the sectors in a day where we did see some good gains. And of course, my brain froze for a moment, but Seven Group was one of the big reporting companies as well. And its shares rose by 7%. And that really did lift the overall industrial sector, even though you saw weakness in the likes of Brambles and Computershare, which was also out with numbers today. Looking at the banks after CBA's results, CommBank just sitting under $134 per share. All of the banks except NAB tracking higher today. Big moves coming through in gold. Had a great conversation with Jonathan Takadina from MPC Markets. You can find online as well, particularly about some of the small plays that they're looking at there. But Evolution came through with its numbers and forecasts for full year 25, and that sent its shares up by almost 7%, while you've also got gold futures tracking above $2,500 an ounce. And having a quick look at the miners, because we did see a dent coming through in iron ore futures in Singapore. Look at that, Fortescue falling below $18 a share, so a big slump of 5% today. BHP, Rio Tinto also coming under pressure, along with South 32. Let's get to some of the news of the day. CBA edging up. The Aussie economy, they say, remaining resilient. They reported a $9.8 billion cash profit, which was down 2% on last year, but it did beat market expectations. Seven West Media gained, even though it reported a fall in profit of almost 69%. And we talked about the parent company, Seven Group, doing very well, really driven by industrials and the likes of Boral. CEO Ryan Stokes I spoke to earlier, and he just said it was a very strategic move that they took 100% ownership of Boral. ASX I mentioned because ASIC is suing the operator for allegedly making misleading statements. AGL we spoke to as well, a turnaround in earnings, underlying net profit jumping to $812 million, so nearly tripling and beating their upgraded guidance that they gave the market in May. And Evolution Mining, of course, after its full year profits nearly tripled as well. So just a reminder that we did conduct a lot of interviews with CEOs today that you can find on our website. Koshi spoke to CBA, Matt Common. I spoke to Ryan Stokes from Seven Group Holdings, also the CFO of AGL, Gary Brown. We also spoke to HDN today. So a lot of company reporting news up on our website. And the stock of the day was CBA. Michael Gable, Fairmont Equities, and Michael Wayne. It was a battle of the Michaels today. They joined Koshi on the call.
Really, they're the best bank. So they're the most expensive bank because they're doing the best job. The numbers were better than what I think most of the numbers were better than what the analysts were expecting, but as you mentioned, David, the analysts have been saying it's a sell all year, so they haven't got it right at all. But obviously, it's been trading well all year. The market has been buying it up.
Revenue fell, pre-provision operating profit fell. These aren't signs of a growth stock that should be trading at 23 times earnings. Obviously, the conditions may improve next year. I mean, impairments were relatively good considering the environment. The capital position of the bank is very strong. Net interest margins were better than expected. So if anything, it was more of a mixed update than overtly positive.
All right, let's have a look at the leaders and laggards in an up day for the overall market. Starting with some of the front runners, Medicus was just speaking then to the CEO, Dr. Sam Hupert, up by 8%. Seven Group, we spoke to Ryan Stokes as well, up 7%. Evolution Mining up almost 7%. Aurora and Fletcher Building also looking good. To the losers today, or the laggards, as Nadine always reminds me, I should say. Fortescue down 5%, below $18 as we see iron ore futures in Singapore below $100 a tonne. Also weakness from MinRes, Champion Iron, Tabcorp and Coronado Global Resources. To the small end of town, Appen having a very good day with a gain of nearly 24%. And on the lagging side in the small end of town, you can see those companies on your screen. All right, let's have a look at what we are expecting tonight. All about the CPI. This is really what the market has been looking for, hasn't it? And we did see softening in producer prices overnight, which added to those bets that the Fed could cut aggressively in September. Looking ahead tomorrow, another busy day in terms of earnings. Telstra, Origin Energy, Arena REIT, Cochlear, Charter Hall Retail, Deterra Royalties, Goodman Group, Magellan Financial Aurora Treasury Wine. Now, I want to let you know that we are speaking to Treasury Wine, Origin Energy, we're speaking to Arena REIT, we're speaking to Cochlear. So, of course, stick with ausbiz.com.au. We've also got the all-important labour force data for July and CBA household spending insights, as Matt Common told Koshi. They are actually seeing the consumer holding up fairly well despite higher interest rates. All right, have a quick look at where the market has finished the day's trade. CBA, of course, higher, pushing the overall market higher, which tends to happen when the world's biggest, the country's biggest stock lifts. And there you can see a gain of about 1/3 of 1%. So we did sort of pair off into the close as we await this key inflation data out of the US, and as we started to see a wobble from those big miners due to a fall, of course, in iron ore. The S&P ASX 200 index down 1/3 of 1%, 7,850 points. Okay, another busy day on earnings season. We'll join you from 9:45 a.m. Eastern tomorrow. Enjoy your evening.